Hello and welcome to Market Domination, sponsored by Tasty Trade. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
The base case is that they're going to slow down their pace. Why? Because the economy is doing fairly well. We're looking at almost 3% GDP growth for this year. Next year, it should slow down notably, but still run above trend. And in that environment with slightly sticky inflation, it's going to be hard for the Fed to continue at this type of pace. So it very much makes sense for them to slow down. And again, we think that they'll project 3 cuts, but we actually think that they'll only do 2.
A lot of people have missed this rally, talked about being overweight bonds. Bonds are up 2% this year. S&P's up 27%. The honest truth, a lot of people manage a lot of money have missed this, and there's still a reason to think they're probably going to want to chase into the end of the year. And that's what you tend to see. Low volume, holidays, everything's out of the way, Fed's out of the way. Probably just an upward bias.
There is clearly some optimism in terms of what the administration is looking to do with cryptocurrencies. In terms of Bitcoin particularly, right? We've seen kind of this institutionalization of that cryptocurrency with ETFs and things of that nature. Right? I think there's still some more room to run.
We got 1 hour to go until the market close, and so we're taking a look at the major averages here. We have some new records to talk about, particularly when it comes to large cap tech. The Nasdaq Composite setting a new intraday and closing high, as is the Nasdaq 100. It's moving up 1.25%. The S&P 500 up about 0.5%. The Dow little change. So this, Josh, continuing this trend that we have seen, where all of the broadening talk, aside, it's large cap tech that's leading things higher.
Yeah, we've talked about how there's different reasons for that, Julie. Yeah. You can chalk it up to earnings. You can chalk it to macro factors. If inflation looks sticky and rates are higher for longer, people want to get defensive, and defensive can mean going to companies with a ton of cash. And also, I did have one venture investor just telling me, listen, he at least thought a part of what you're seeing here, too, no surprise, he would chalk it up money managers maybe chasing some year-end performance as well there.
Interesting. Maybe, I mean, should all of those things maybe apply to Bitcoin also? Because that's another thing that we keep seeing push higher and higher. It broke 106,000.
More than doubled this year. Yep. All right, for more on the latest market moves as investors count down to Wednesday's Fed meeting, let's welcome in now Scott Chronert, City Head of U.S. Equity Strategy. Scott, it is good to see you. So, Scott, we're wrapping up a great year here as we roll into 2025. You tell your clients, Scott, broadly stay positive. How come?
Well, I think the underlying fundamental trajectory is in really good shape. We've been pitching this no cycle thesis for the better part of this year, which basically says we're in this ongoing paradigm still coming out of the pandemic. And what we've seen is a fairly resilient fundamental circumstance and economic circumstance, even against 2 years of Fed hawkishness. So now we're kind of navigating, let's call it policy uncertainty with the new Trump platform, ultimately should give way to policy opportunity on the other side. All told, fundamentals look in really good shape going into 25 and should persist into 2026. This keeps us pretty constructive on U.S. equities.
Well, and Scott, that also implies that you think that policy uncertainty will resolve itself in a way that is favorable or at least not harmful to the earnings growth and stock returns that people have become accustomed to over the past few years.
So, we don't have a lot of information now relative to what we had even 2 or 3 months ago. So we've done a lot of back of the envelope modeling on this. And our high level takeaway is that we're probably going to see some company specific industry group or sector responses to some of the specifics around tariffs, deregulation, maybe tax reform and so forth. But all told, we're looking for low teens increase in S&P 500 earnings next year. And we don't think that the Trump policy impact will detract too much from that underlying trend.
Scott, looking back on 2024, what surprised you as a strategist?
Yeah, I don't mean to say this in a sort of a comical fashion, but if we were having this discussion in the early part of January, and I would have told you that the S&P was going to finish the year 24, if not 25 times earnings, I'm not sure you would have invited me back on. But essentially what this has been one big valuation surprise. Earnings expectations for full year 24 are not too far off from where we were looking at the beginning of this year. So essentially, it's been a valuation move dominated by the Mag 7 mega cap growth cohort. But essentially, it's been this ability of investors to look through a lot of the near-term noise around Fed and economic activity toward its underlying fundamental improvement, pricing in soft landing, AI growth tailwinds, and now to come probably still some opportunity around the Trump platform.
Scott, you mentioned valuation, and there was an interesting chart that you all put in your outlook where you looked at the forward price earnings ratio of the S&P 500, or excuse me, of the Magnificent Seven versus the S&P, and then versus the S&P minus the Magnificent Seven. Now, looking at this chart, it's clear, obviously, that the Mag 7 are trading at higher valuations. But what are your other takeaways from looking at how valuations have developed here?
So, I mean, this is the great storyline. So essentially, if you look at the Mag 7, their forward peg ratio, as we call it, has actually come down, right? So the Mag 7 is trading maybe 90th percentile versus history, but what's been happening is that the earnings growth has been so strong, it hasn't led to a dramatic valuation increase. These are high multiple companies anyway. On the other hand, the other 493, which is going to encompass the big chunk of the market, obviously, is actually trading at a more expensive valuation versus its own history. What this tells you is, to my earlier point, the market is quickly pricing in a lot of soft landing enthusiasm, AI tailwinds, and then, as I mentioned, the opportunity around the Trump policy platform. So it's this other 493 that we need to see stabilize from a fundamental perspective and then broaden, and we think that's going to be the case for next year.
Do you think, Scott, when you look at people, folks piling into these Mag 7 names, and you could look like an ETF like the Mags, for example, which is hitting the record. How much of that is earnings, Scott? And how much of that is also perhaps a defensive move here? Meaning, if you think inflation is maybe proven a little stickier than some imagined, and rates are higher for longer, investors start looking for what they would consider more defensive names.
Yeah, it's a really good point. So the way we're talking about it more recently is that we're thinking the Mag 7 actually unfold as a quasi-staple, right? So usually you go to staples when you have uncertain economic conditions because of the persistence of earnings growth. The Mag 7, we think that forward-looking earnings growth certainly for 25 and probably into 26 is fairly visible. So all told, when you get concerned about other things that work in the market and the economy, the Mag 7 actually have this potential to be a, quote, defensive, if you will. We use the phrase growth is defensive periodically, and that's what's going on here. So essentially, I think that's what we are looking at is near term, let's call it 1, probably 2 years visibility. That's pretty good for these companies. What the issue becomes with them is whether that perpetuates in, say, years 3, 4, 5. The market's starting to price in that perpetuation. So we need to be sensitive to both sides. These companies probably can't just live on meeting expectations. They need to continue to meet, beat, and then probably raise forward expectations as well.
Well, and Scott, sort of to put a fine point on this and also combine it with the last point you were making, everybody is talking about broadening, including you, and that is necessary for the rally to keep going. But it hasn't necessarily been necessary in the past. In other words, in the past, the Mag 7 going up was enough to pull along the rest of it. What changes in 2025 that's not going to be enough anymore?
Yeah, well, I think it's law of numbers, law of large numbers, and can they continue to grow earnings at their current pace? One of the themes that we think is at play for next year is what we call earnings growth rate convergence. And essentially what happens, if you look at the projections for the Mag 7, they're still growing quite notably, but it's at a decelerating clip versus what 23 and 24 was. On the other hand, the other 493, the value side of the S&P, even going down into small mid-cap, all of them are coming off of relatively flattish earnings growth years where the inflection now presumes to be to an acceleration mode. And so what ends up happening is that the growth rates between mega cap growth and these other elements of the market begin to converge. We think that's a really positive sign. And I think in terms of a healthy way to future market gains, you really want to see this broadening effect kick in, and we're pretty comfortable it will.
And Scott, you mentioned the Fed earlier. I'd love to get your take. What do you expect at the big meeting this week? What do you think they'll do, Scott? What should they do, in your opinion?
Well, I think another 25 basis points makes a lot of sense here. I mean, they're going down a less restrictive path for sure. we've begun talking a little bit more about a new Fed normal, and that is, I think the equities are in good shape with the current market implied trajectory of, let's call it 100 basis point reduction over the next year. It's probably going to be with fits and starts, but all told, I think what we have to expect is that the Fed obviously has its eye on the ball here, and this gradual reduction in restrictiveness makes a ton of sense from our perspective. And so all told, what we're looking at the Fed is that it's going to be an important dynamic at work here. I think probably at the margin, we're going to be a little bit more focused on where some of these Trump policy proposals take us.
And finally, Scott, is there a place, beyond just the broad averages, are there specific sectors where you think investors should be looking next year?
Well, we haven't updated our year-end sector playbook, but going into Q4, we feel pretty good about the positioning. And essentially, we've been thinking about this fully valued market in a bit more of a, what do you like versus what you don't like. So we've been looking at sectors paired against each other. So for example, we've been talking about financials of an overweight versus healthcare underweight, consumer discretionary overweight, which has been pretty controversial against an industrials underweight, communication services, which is where you catch the internet names, overweight versus consumer staples. And then lastly, we've been working energy against materials. So all told, we think under the index surface, there are lots of pretty intriguing sector setups. Tech's a little bit unique here. We're market weight tech. We actually prefer semis a little bit more right now versus the strong performance we've seen recently in the software side.
Interesting. Well, we're going to talk about semis later in the show, so perfect timing. Scott, thank you so much. Appreciate your time today.
You bet.
We're just getting started here on Market Domination. Coming up, tax cuts are coming. President-elect Donald Trump speaking earlier today at Mar-a-Lago, reaffirming his policy plans. We'll see if he can actually get them done. We'll get to the key takeaways on the other side. Plus, trouble in paradise. NVIDIA shares falling again today, while the rest of the Magnificent Seven continues to soar post-election. We'll check in on the chip giant later in the hour. Stick around, much more Market Domination still to come.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetnista, your favorite financial educator. Welcome to Capital Gains World. For a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
We're going to further reduce taxes. If you remember when we reduced them last time, that brought a tremendous amount. We brought it down to 21%, and that was the biggest tax cut in the history of our country. And nobody ever thought this would happen, but this is what's supposed to happen. We actually ended up taking in more revenue at 21 than we did at 40%, which was pretty amazing.
That was President-elect Donald Trump earlier today, speaking of his plans to lower the corporate tax rate from 21% to 15% early in his second term. Joining us now to help break down Trump's policy plans, Libby Cantrell, PIMCO head of U.S. Public Policy. It's good to see you, Libby. That was President-elect Trump in his first press conference since winning the election. He talked about a lot of different things. We're zeroing in first on that tax comment because it's one of the things that has seemed to help buoy the markets, this promise of less regulation and potentially tax cuts. But do you think that the chances are good that he's going to get that corporate tax cut?
Yeah, well, it's nice to be here. I mean, I think that for one, it's what's very clear, I think we can say with high conviction, is that the expiring individual Trump tax cuts that are all expiring at the end of next year will be extended. There's just way too much on the line for members of Congress and then also for President Trump to let the economy go over that fiscal cliff. These other areas, however, that he had promised on the campaign trail, whether it was the decreasing the corporate tax rate to 15%, and that keeps changing because he's talked about decreasing that just for U.S.-based manufacturing companies. Now he's sort of talking about it more generally, in addition to raising the SALT cap from 10,000 to increasing that to no taxes on tips. This is where the proverbial rubber will meet the road, in that the House majority in particular is going to be incredibly narrow for Republicans. So while all of this is fantastic platform to run on and obviously has been boosting markets, I think the reality, just in terms of governing, may be quite different. And again, we will see an extension of those individual Trump tax cuts, but whether that actually translates into a broader tax bill, I think is a real open question. And I think the markets just need to realize that these majorities that they're going to be navigating are much smaller. They're historically small. Republicans have never had as small of a majority as they're going to come 2025. So long way of saying, again, I think the rhetoric is making the market happy, but I think the reality might be a bit different when actually kind of push comes to shove.
Well, and there's another piece of historical reality that I would love your perspective on, Libby, because you're really steeped in this stuff, and that is whether indeed, because there's always been debate about this, whether tax cuts, he mentioned that after they did the tax cut, it brought in more revenue, and there's always sort of debate about the numbers and how you slice and dice them, and then also what that means for deficits, et cetera. So what has tended to happen when taxes have been cut?
Yeah, and I think it really depends on the numbers that you're looking at. I mean, this, if you look at just the CBO score, that may not be exactly right in terms of more revenue being generated, at least on the corporate side. But I think there's, broadly an argument if you're looking at, just GDP growth and what have you, and optimism that maybe both sides can be right. But I think if you're looking just at corporate revenues, at least after the tax bill was signed into law, I'm not sure that's exactly right, but it also depends on the source too. But the Congressional Budget Office and sort of the neutral, nonpartisan world is the source, and I think that tells a little bit of a different story than what the president was talking about today.
Libby, another question for you. The Journal had a good piece about how the tax cutters right now are kind of beating the deficit hawks in the GOP's sort of fiscal tug of war. Which is a really interesting sort of competition there and tension internally. I'm just curious about what you make of that. Do you expect that to continue?
I think what we were telling our clients, that regardless of who won in November, that the deficit would be the biggest loser. And that is because, of course, the initial conditions here are just pretty awful. I mean, 6.5% deficits as a percentage of GDP. And while there's certainly attention to the deficits with the DOGE effort, and there may be actually some spending cuts to really move the needle fiscally, you either have to increase taxes, which no one wants to do. Even Democrats actually don't really want to do that necessarily. Or you really have to take a hard look at some of the entitlement programs, whether it's Medicare, Social Security, or other healthcare obligations. And there's just, simply not the political appetite to do that on either side of the aisle. So, I think to answer your question about, are the more kind of profligate folks outweighing the deficit hawks, I'm not sure how serious the deficit, the deficit reduction effort really is, sort of, period. So again, we may see some spending cuts, but will that really offset the cost of the extension of the tax cuts? Most likely not. And even if it's neutral, again, we're just starting at a pretty horrible, place in terms of 6.5% deficit to GDP. So this is not a partisan comment. I think that, again, Democrats would likely not have reformed the deficit either, would not have brought down the deficit. I just don't think that there's this sort of hope that, DOGE and what have you will really meaningfully change the fiscal trajectory. We wish them well, but I guess I'm more skeptical that actually will come to pass.
Libby, switching gears here to something a bit more near term. Federal agencies run out of money Friday night, I believe it is, Libby. The bet seems to be we're not going to have a government shutdown. A deal is going to get done. Is that your bet, Libby? Is that what you're telling your clients?
Yeah, the market is sort of, I think rightly so, desensitized to this drama coming out of Washington. There will be a continuing resolution which will fund the government, most likely to March. And so I think that any fears of a government shutdown, are kind of misplaced. So yes, I would say the conventional wisdom is right here. I think a question for the markets, though, is do some of these provisions that actually could make at least a sector difference, whether it's energy permitting, whether it is restricting, outbound investment to certain areas of tech to China, does that actually get passed? And I do think there's a maybe 50-50 chance that we do get some of these provisions sort of attached at the last moment. So the story for the markets is not whether the government will be funded until March. It will be. I think the question is, do you actually see sort of some of these last minute provisions that could, move sort of some sectors, at least incrementally, attached at the last minute? And that's an open question.
And Libby, also on the sector front, not related to the shutdown, but a sector that's really been in focus as of late, pharmacy benefit managers. The president-elect talked about that again today. He talked about what he calls the middleman, which is effectively what these companies do. We've heard some bipartisan noises on the Hill about trying to regulate these guys more. Do you think that happens? I mean, we're seeing shares of companies like CVS, for example, fall today.
This has been, I think the question is, it's an open question. There has been a political momentum to reform the way that this works really since, Obamacare in many ways. But, even more recently during the Inflation Reduction Act and the negotiation of pharmaceutical drugs that, Medicare buys and what have you. So this has been on the table in many ways. It just sort of hasn't gotten over, the goal line, to mix my metaphor. So, it's certainly a possibility. And again, this is sort of one of the other last minute provisions that I do think that potentially could be attached. But regardless if it's attached or not, this area of the pharmaceutical market will face headwinds. And I think they would have faced headwinds kind of regardless whether it would be a Harris administration or Trump. But it will certainly face some obstacles or headwinds in the Trump administration.
And finally, Libby, you look at the market right now, it seems very excited about pro-growth policies under Trump. So we're going to get, cut taxes, cut regulation, and maybe the market thinking, when it comes to tariffs, ultimately the policies will be a lot more moderate, Libby, more orthodox than the rhetoric perhaps suggests. Is that what you think?
Yeah, I think the equity market is, its enthusiasm is well placed. I mean, deregulation, or at least the absence of new regulation, kind of clarity around regulation, this hope for maybe additional tax cuts, at least, certainty around an extension of the tax cuts. We're not going to see taxes going up like we may have under Harris. So I think some of this enthusiasm is very rightly placed. I think the fixed income market might be a little bit more focused, like we oftentimes are, on the things that can go wrong. And I do think we do think that you have to take the president seriously on the risk of tariffs. We don't necessarily think it's just a threat to get concessions from other countries. That's certainly part of it. Like he likes a transaction. He's, we'd say tariff man and transaction man. But I would say don't underestimate just the long-standing ideology that is underpinning some of these threats around tariffs. He truly believes, and his team believes, and we're not here to disagree or agree with them, that the trade deficit is a symptom of a much broader problem, and that countries that run trade deficits with the U.S., that should be, addressed. And tariffs are, in their view, a very effective way of addressing it. So I think we probably would sort of split the baby a little bit. We would take him seriously on a lot of this. Will he do exactly what he's saying? Probably not. But I also think that folks who are just thinking that this is just a threat, that this is all bark and no bite, aren't necessarily paying attention to what the president-elect has been saying for almost 4 decades about tariffs and about trade deficits and just generally about protectionism. So again, what we say, we think it's probably more of a muddled middle, but I think the fixed income market might be priced a little bit more for some of those tail risks than the equity market is.
Libby, is the tariff threat the biggest threat, do you think, to this ebullience in the stock market in terms of Trump policies?
Well, again, we don't want to be the sort of the Debbie Downer here. There are a lot of reasons why the equity market should be very enthusiastic about 2025. But in many ways, it does feel a little bit like it's priced for perfection. And if anything kind of wobbles, you could see, that potentially impacting sentiment. So, day one, is he just issuing executive orders announcing things that roll back some of the Biden regulation, or is he also announcing tariffs? I think we probably think a little bit of both, honestly. So in many ways, I don't think it takes very much to upset the kind of risk-on narrative, because it is priced for all of this kind of going very well, and for some of these risks not necessarily manifesting.
We'll see what happens, and we'll catch up with you, of course, regularly as the year progresses. Libby, thank you so much.
Thanks so much. Appreciate it.
Well, President-elect Donald Trump's upcoming second term already shaping up differently in terms of a level of support compared to his first term. Here with more on this, let's get to Yahoo Finance's Rick Newman. And what we're referring to, of course, Rick, is this sort of line of CEOs very publicly, in sharp contrast to last time, approaching Donald Trump.
And this includes some people who you could describe as Trump antagonists from the first time around. Jeff Bezos, he was in kind of a spat with Trump during the first term. Mark Zuckerberg of Meta, he took down Trump's Facebook account after the January 6, 2021 riots, other people like that. Basically, many CEOs now seem to be getting on board the Trump cause, the Trump train, one way or another. Some of them are donating money to his inaugural committee. That's sort of a way to show support for the presidency without it being overtly political, because that's not a Democratic or a Republican thing. That's an event committee. Trump is going to be meeting with apparently another 15 or so CEOs down at Mar-a-Lago in Florida this week. So what exactly is going on here? What I think these people are doing is, number one, they're looking around Washington and saying Trump is the only game in town. I mean, Democrats are flat on their back. They got completely smoked in the 2024 elections. They lost control of both houses of Congress, and they don't even have a leader, an obvious leader among them. And Trump's going to be calling the shots for the next 2 years, 4 years, possibly J.D. Vance is the next generation of Trumpism. And guess what? A lot is going to happen during the next year or two. With a Republican Congress, Trump's going to be able to pass legislation he would not otherwise be able to pass. There's a lot he's going to change through regulations. And the Musk Efficiency Commission, I mean, it doesn't have the authority to actually change the government, but it will make recommendations to the Trump White House. And I mean, any company that is regulated by the federal government in some fashion, and I think you could fairly say that as most companies are subject to some sort of regulation, man, they would all love to have a say in how whatever agency regulates them does its job. So you can imagine those CEOs are like, hey, can I get a word with Elon or with whoever is going to handle, OSHA or the FDA or whatever agency it is that regulates their company. So I think everybody wants Trump's ear because they look at what's happening and they see, look, Elon Musk does have influence. Maybe I can too.
Another person who wants his ear, Rick, we saw Masa-san today, SoftBank CEO. You saw Masa-san and Trump unveiling this $100 billion investment in the U.S. Rick, what'd you make of that headline?
Well, the most interesting thing is that Trump is not even president yet. And normally you would do that with the sitting president. That's not happening. And like, who even remembers the name of the current president anymore with all this stuff going on? Let's be a little careful here because, first of all, this supposedly is going to be in artificial intelligence and other forms of technology. I'm not sure you get 100,000 jobs out of, investing in AI. And let's remember what happened with Foxconn in Wisconsin. Foxconn, there was a big unveiling. Trump's going to bring this company to America. That project basically went kaput. Foxconn ended up doing hardly anything of what it promised at all. The whole thing went kerflooey just a few years later. So a lot of these announcements don't add up. But look, Trump has got momentum right now. And not for nothing, his approval rating is actually the highest it's ever been in his all his years in politics. It's actually higher now than it was for most of the time he was president. So let's see what happens in 2025.
Well, we know how these things usually go in terms of approval ratings, right? For no matter who is the president, right? They kind of trend lower as time goes on.
Unless something happens. Let's keep in mind the 9/11 attacks boosted George W. Bush's popularity by a lot. It's a dangerous world. There's some crazy things going on. I think a year from now, we're going to be talking about some events in 2025 that nobody is foreseeing right now.
Important caveat. Thank you, Rick. Appreciate it.
Bye, guys.
Now time for some of today's trending tickers, sponsored by Tasty Trade. As always, you can scan the QR code below to check out the best, worst, and most viewed stocks of the session on Yahoo Finance's trending tickers page. We're looking at chips today, really focusing in on shares of NVIDIA, that hitting a sluggish run, stock falling. It's now down more than 10% from its record close last month. You want to know when its record close was? The day of its record close? It happened to be Election Day. And since Election Day, NVIDIA is down. It's in fact now down well more than 10%. It's getting closer to 11, 12%. The rest of the Magnificent Seven, all of them have been higher. So if you look at that ETF that tracks the Mag 7, it's up. If you look at each of them, especially Tesla, which has far and away been the winner, they're all up. NVIDIA is one of these things is not like the other situation.
And we spoke recently to Nancy Tengler, who a very smart investment strategist and NVIDIA bull, and I was asking her about this and what sort of she thought explained that, and I bounced one idea off her, which is, could it be in part that there's a product transition occurring at NVIDIA? Could that help explain some of the weakness? And Nancy basically just told us that she just thinks the market has a short-term memory. She actually told us she was using this weakness to add to their position over there. Because I think her bottom line to us was, Julie, she looks at Gen AI spending and it's still going very strong. And her bet, like a lot of folks, is if that's true, then Jensen Huang is a beneficiary.
Well, the sort of new hotness over the past few days in the market has been Broadcom. In contrast to NVIDIA, it was up 24% on Friday following its earnings. It's up again today by double digits. And yes, the reception to Broadcom's numbers was impressive from analysts. However, what's interesting is if you look at the outlook for next year, you look at a Stacy Rasgon from Bernstein, you look at a Vivek Arya from Bank of America, they like both stocks going into 2025, both NVIDIA and Broadcom. I had a chat on the phone today with John Vinn over at KeyBank, and he said there seems to be this view now that people had been waiting for the custom silicon wave to come. In other words, the hyperscalers, other companies start to design and have their own custom chips. And Broadcom is seen as a main beneficiary of that, particularly following its report. He happens to think that it's premature, that we're seeing this real shift in the market, but that is a shift people have been waiting for.
Yeah, in terms of just showing the love for Hock Tan's company, per Bloomberg data, all in, 25 analysts have now raised price targets by an average of 19%. No analyst cut price targets on Broadcom. No analyst downgraded. 12-month target is around 232 now.
Yeah, and what's so remarkable about that? That company matched estimates with its earnings. It was all about the commentary around AI, around the total addressable market for these custom chips that we're talking about, and what that is going to lend to Broadcom in the future. But it also gave a big range. It said maybe that AI market could be between $60 to $90 billion by fiscal year 2027. 60 to 90 is a pretty big swing.
You had mentioned Stacey Rasgon, who took his target to 250.
Yeah.
And Stacey kind of told his clients, when for him, he looked at Broadcom and said, bottom line, the AI story there just seemed to be kind of really coming together for Hock Tan, and a lot of people obviously agreed with him.
Yes.
All right, coming up, Walmart is the winner of the 2024 Yahoo Finance Company of the Year award. We're going to be joined by an analyst on the other side to break down the year that was for the retail giant and get an early look at who could make the shortlist for the award in 2025. Stick around, much more market domination still to come. Well, Walmart has seen impressive sales and profit growth outpacing key competitors. The stock price has also meaningfully outperformed the S&P 500, all contributing to Walmart's selection as Yahoo Finance's Company of the Year. But we're not the only ones to take notice of the retail giant's star power. TD Cowen recognizing Walmart as one of its best ideas for 2024. And TD Cowen senior research analyst Oliver Chen joins us now to discuss all this. Oliver, it is great to see you. So let's talk Walmart, Oliver. It has been a remarkable year. I mean, that stock is up about 80% in 2024, Oliver. Obviously a company that's just firing on all cylinders. Does that continue into 2025, Oliver?
Josh, we continue to be excited about the technology that Walmart offers, as well as this everyday low price. So you think about everyday low price meets technology, meets convenience. These will all still be great features for the year ahead. There's a lot of uncertainty right now, particularly with tariffs and suppliers and pricing. Walmart's very well positioned to continue this awesome growth. That being said, it's had a tremendous run, and the PE multiple is fairly high at this level at 34 times. It's still a key idea for us in terms of an idea we like. In terms of our new best idea for this year's, it's BJ's Wholesale. But we're continue to be excited by the Walmart story.
Oliver, I want to dig into BJ's in just a minute, but let's give you a little victory lap here real quick for choosing Walmart as one of your best ideas of the year, because obviously that did pan out well. I'm curious where it exceeded your expectations and if there were any areas where you think things could have gone a little bit better for Walmart this year.
Yeah, Julie, where we're really excited is the progress they've been making with digital advertising. It's only a $3 to $4 billion business for Walmart. It's about 50 billion at Amazon and Google, so lots of runway. Also, their online business has been fueled by expansion of the marketplace and continuing to offer new sellers on the marketplace. And then you put that and you marry that with a very awesome grocery business, which is about 60% of total. They've worked hard with suppliers to make sure everyday low price and value is there for customers. So we got both, and this company has executed better than ever in terms of marrying these pieces together and offering a need plus a want retail experience. What's been better than expected is Walmart's been getting more higher household income customers. So having such good convenience, curbside pickup, the marketplace model, that's been great for getting wealthier customers. Opportunities going forward, apparel is still an area that can improve, and there's renovations and changes being made here. And we also continue to watch general consumer discretionary trends because the consumer is very cautious right now in terms of spending. And some parts of innovation, such as electronics and home items, there's been less innovation in these areas. So it's an option value on the upside, an opportunity.
Oliver, let me ask you, because you cover both things. I'm just curious, what is Walmart doing, Oliver, that Target isn't? Because that stock, 2024, it's in the red here, Oliver, and I know you have a hold on that one.
Yeah, Target, we want them to win, and Target is very famous for merchandising and private label. What Target really needs to do is shorten lead times in their home category. Target's also primarily consumer discretionary, and over half of Walmart is food and grocery, and consumers are really focused on needs. That's benefited Walmart a lot. Also, Walmart's moved a little bit faster with the marketplace model, having third-party sellers. That's been better for Walmart. And Walmart's also worked very hard on supply chain and fulfillment and curbside pickup. So their journey on profitability on e-commerce has been better. The bottom line at Target, it's been fairly volatile because it's so consumer discretionary focused. So opportunities to improve their home assortment, get the lead time shorter, and better match supply and demand. We have a customer that's always looking for deals and bargains and values. Target needs to find ways to stabilize their in-store traffic a little better.
Oliver, let's get back to your top pick going into next year. You mentioned it's BJ's. And also, this comes back presumably to the value theme. This is a stock, though, that's already up some 47% or so thus far in 2024. So what's going to drive the momentum further next year?
Well, there's a real growth opportunity at BJ's. Keep in mind, there's only 250 clubs versus 600 Sam's Clubs and 610 Costco. So as we look ahead, adding about 10 units per year is attractive and scaling. Also, the PE ratio at 23 times, Costco's at 50 times, Walmart's at 34 times. That's a nice opportunity too. And BJ's enables you to do the full wholesale club trip in terms of buying produce and offering more food and service as well than Costco. So growth opportunity ahead. They only have 3% share of a growing market, and it's a very attractive underlying wholesale club model market as well, and customers are focused on value. That's what we see ahead at BJ's. Also a very strong digital offering as well.
Oliver, I got to ask, because you mentioned tariffs. I'm just curious. I would guess, Oliver, you're fielding questions about that from your clients. I mean, to the extent that we see these potential tariffs, Oliver, are there certain names in your coverage universe that would be better positioned than others? What would it, for example, mean for a Walmart?
Yeah, the bottom line is tariffs can be quite detrimental to the earnings per share analysis. As we look at the sensitivities, it could hurt earnings by a mid to high single digit percentage, if not more. It depends on the pass through. That being said, the best positioned retailers are those with the most scale and bargaining power. And Walmart's shown that time and time again with their rollbacks and their ability to negotiate with suppliers. So Walmart, another name that we like is Costco as well, in terms of it being the low-cost merchandiser, very vertically integrated. And then at the other end of the spectrum, what kinds of goods have pricing leverage? We do like LVMH in terms of luxury goods. This is an evolving thing that we're watching. We think consumers are going to not be willing or interested in taking price increases, so it'll be a debate on what happens.
Love that barbell. Oliver, thank you so much. It's great to see you.
Happy holidays.
You too. Coming up, shares of Okta getting a boost behind a bullish analyst note. We'll check in on some of the top calls of the day when market domination returns. Some breaking news. TikTok and its parent company ByteDance have filed an emergency appeal at the Supreme Court seeking to delay the law that would ban the social media app nationwide. The emergency request comes after a federal appeals court upheld a law banning TikTok in the U.S. if its parent company does not sell the app by January 19th. Now, that means the ban would kick in the day before President-elect Donald Trump is inaugurated. Earlier today, Trump said he would consider reversing his stance toward TikTok, saying now he has a soft spot for it. He attributes that to Republican gains with young voters to the platform. TikTok's lawyers wrote in the application that the act, they say, will silence the speech of applicants and the many Americans who use the platform to communicate about politics, commerce, arts, and other matters of public concern.
All right, let's get to some calls of the day now. JP Morgan upgrading Okta from neutral to overweight, so they are buyers. Well positioned, they tell their clients, they think for increased demand. They see potential for meaningful improvement in fundamental performance. Risk reward is attractive. They also add that 7% growth in 2026 there is conservative in their opinion, Julie.
Yeah, they have this product, this identity product that the folks over there are bullish about. And so some of this has to do with that, with the growing strategic importance of identity security, as they put it, and that the company is well positioned for top line reacceleration, according to the analyst there. And as we see, the shares are rising today. You know, we've seen kind of a rocky road for some of these types of stocks this year. In terms of how Okta has done this year, I'm going to look right now because I haven't looked yet.
Not good.
Not good? Tell me. I
No,
knew you had it.
in the red.
In the red this year, down 6%.
Growth, they say, is going to be driven by large enterprise momentum, its ability to sell new products, international penetration. It has not been a great year for Okta, but listen, JP Morgan clearly looks at that and says opportunity.
Yes. All right. Let's also take a look at some telecom stocks. Morgan Stanley coming out with a new note on the telecom and cable sectors overall. And the note, including names like Comcast, T-Mobile, and AT&T. AT&T is the top pick there for that team led by Benjamin Swinburne over at Morgan Stanley. And he's looking broadly at the industry here and saying that there's growth of over $200 billion in the wireless market, but that's expected to decelerate over time. There should be continued growth in devices and connections per consumer, household, and business customers. And so they're looking at the sort of four-player market: Verizon, T-Mobile, AT&T, and cable as the four players continuing here.
Did also downgrade Comcast to equal weight, I saw on that note. We expect, they told clients, cable to face challenging broadband trends and EBITDA growth in 25. I also thought it was interesting what they said about M&A. Just obviously that is top of mind, you know, with Trump coming back in, the expectation will be a friendlier backdrop. But the analysts there saying, listen, bottom line, transactions here would require the approval of both the DOJ and the FCC and should be viewed as low probability events in our view.
Yes, that was a very interesting comment.
Yep. All right, moving on. Increased drone sightings are leading to calls for action in the Northeast. New York Governor Kathy Hochul saying that it's gone too far and calling for federal assistance. For more, we're bringing now George Ferguson, Senior Aerospace Defense and Airlines Industry Analyst at Bloomberg Intelligence. George, it's good to see you. So, you know, obviously this is top of mind, George. Everybody's talking about the drone sightings, New Jersey, New York. A lot of reports, George, a lot of rumors, a lot of speculation, social media. You know, my feeds were blowing up over the weekend with all kinds of theories. But what do you make of it, George? What do you think's going on here?
Yeah, so I mean, I think that there's probably some misconceptions by people on the ground over what's a drone and what's an airplane. In some cases, I think there is some drone activity, but I don't know that it's you know, anything different than what we'd normally have. And I think that includes maybe a lot of recreational drone users, and maybe there is a little bit of surveillance going on by people that are trying to take a look at U.S. military installations here and there. I think that goes on regularly. But I think it's nothing sort of too far out of the ordinary. Just maybe there's more darkness right now than there is most parts of the year. And every time you look up and you see blinking lights, you wonder what that is. And some people let their imagination get a little crazy, I think.
Yeah, there does seem to be at least part of that going on, George. It's good to see you. You know, whatever the reason, we have heard some of the authorities, Kathy Hochul of New York, for example, saying that maybe they're going to take some measures to take the drones out of the sky, send up their own drones to take a look. And that led us to wonder if there are any companies, especially publicly traded companies, that would be appropriate for that kind of work.
Yeah, so this is something I think you're going to see some of the smaller tech companies do a lot of work at, probably non-public companies. But I also think some of the bigger defense primes will participate as well and make some money from this. I don't know that it's going to move financial statements, but I think companies like Lockheed, Northrop, Raytheon, all well positioned with technologies like radars, technologies that intercept signals, radio signals, you know, that I think will be involved. And look, I think, you know, as much as I said, there's a lot of, I think, speculation going on right now in the Northeast. There is always, I guess, a certain amount of drone activity in the world, surveilling or trying to, you know, sneak into, who knows, maybe a sports, you know, game or something like that, and get video footage and things like that. And I think this just reinforces, one, that drones are more and more prevalent in the world. That they're going to go places that we won't want them to go, either from a commercial or defense perspective. And there'll be a lot of money spent in technology to try to find a way to keep them out of those spaces. You know, it's hard to sort of knock them out of the sky and not hurt people, but there's other technologies you can use, like jamming, things like that, to try to prohibit them from going into certain areas or from broadcasting out of them. And there'll be a lot of money continue to be spent on that.
Yeah, that's where I wanted to go, George. I did see some analysts who cover some of the same names you do, George, and they were telling their clients today they did expect, in their words, to actually see a surge in counter-drone investments by government agencies, both local and state. Is that what you would be foreseeing over the next 5-10 years?
Yeah, I do. I think the surge has already started, right? I think these are problems we're seeing in Ukraine, right, where we're trying to help Ukrainians protect against cheap Iranian drones, Russian drones. And so It isn't new. I think the surge of spending could, again, come from maybe a state and a corporate level. Again, I don't know now that I think, right now, I don't think it's going to move the financial statements dramatically at those companies. It's hard. I mean, these are companies building like strike fighters, right? Which go for $75, $100 million a pop. So it's hard to do a lot of drone work and make it move the needle very quickly, but it's a very important area of research, development, and I'd expect all those companies to be deeply involved in it.
George, great to have you on the show today. Thanks as always for joining us. Appreciate it.
Thank you.
And while we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
That's the closing bell on Wall Street, and now it's Market Domination Overtime, sponsored by Tasty Trade. We're joined by Jared Blickery to get you up to speed on the action from today's session. Let's start with the major averages here. Mixed picture for the majors, particularly the Dow, which took a little bit of a leg down at the end of the day, off by 110 points when the session finishes here, down about 0.25%. The S&P 500 up 0.4%, and the Nasdaq, the big winner on the day, again, up a 1.25%, closing at a record. The Nasdaq 100, by the way, also at a record today, up almost 1.5%. Again, illustrating the strength that we are seeing in large cap tech. Now, we talked to Scott Chronert at the top of the show from Citi, and he talked about that maybe investors looking for stability are looking towards perhaps some of the mega cap tech names. But we should also mention it's not just the Magnificent Seven. Really, the standout over the past couple of sessions has been Broadcom. NVIDIA entering a correction. Broadcom on the flip side really seeing a lot of investor money into that stock. It was up more than 10% today. So that is certainly part of the story when we look at the strength in tech as well. Jared's got a closer look at today's action. Hey, Jared.
Thank you, Julie. Yes, it's been all about the big ones, and we got a number of records. Nasdaq 100 on your screen here, that was a record, as is the Nasdaq Composite, as is tech and consumer discretionary, both of those large cap sectors. And let me just dial up our sector action for today in those two top spots. And then in number 3, we have communication services, but those two top ones are consumer discretionary and tech. All three of those comprise the mega cap sectors, and those were the only ones that outperformed today. So just kind of furthering that theme that Julie was talking about. To the downside, energy was down by more than 2%. Healthcare, which has done pretty bad recently, that is down by more than 1%. And taking a look inside the Nasdaq 100 of the mega caps, now you can add Broadcom to that list. Broadcom is getting up there in size. In fact, let's see exactly $1.167 trillion for Broadcom right there, compares to Tesla's 1.486 right next to it. But Tesla was the leader among the mega caps. Alphabet up 3.6%, and NVIDIA, as Julie said, suffering a little bit of red today, down about 1.5%.
Thanks so much. Appreciate it, Jared. Tech stocks leading the way on Wall Street as investors kick off the final full trading week of the year and wait on Wednesday's Fed decision. Our next guest says with valuations high for the stock market, one area to consider is high-yield bonds. Joining us now, Bill Zox, Brandywine Global Portfolio Manager. And Bill, I know you look at high yield. That's your area of focus here. Why should investors be looking at it now, and how do you think about its relative value compared to other assets at the moment?
Well, if you think about the asset classes on either side of it, we'll start with equities. And I hate to be Scrooge here, but stocks are up 40 to 50% in 14 months. Valuations are very high. And if equities like to climb a wall of worry, I'm not seeing much worry out there right now. So I do think you have to think about, look, earnings are expected to grow nicely next year. If they do, maybe equities are fine. But longer term, I think returns for these levels for equities are going to be probably fairly low compared to historical norms, and especially if interest rates don't come down materially.
And so is your point, Bill, as you say, so you think of high yield as kind of a middle ground here, Bill, between core fixed income and equities?
That's right. That's right. And then on the other side, core fixed income has been struggling for quite some time. And since the Fed cut by 50 basis points to start this rate cutting cycle off in September, core fixed income has actually been performing poorly with, we've taken almost 75 to 100 basis points of rate cuts out of the market. And, we'll see where we go, but the 2-year yield and the 10-year yield are still pretty close to each other. And I think if we get a more normal relationship there, core fixed income could struggle with a 10-year treasury, 4.75 to 5%, somewhere in that range. That would not be pleasant.
Of course, we've got a Fed meeting this week. Are you in the same camp as pretty much everybody that will get that quarter point cut? And then I guess more importantly then, what happens after?
I do think that we get that quarter point cut. I think the Fed would have made it clear if we were not going to get it by now. So I think we get it, but then maybe we're looking at another 1 to 2 cuts over the next year. And it's also possible that we shift our focus to rate hikes rather than rate cuts at some point next year. So again, that could be tough on core fixed income. That could be tough for equities too. High yield is, as you said, it is in this middle ground, but we've got a nice yield of about 7.2% in the high yield market right now. Fundamentals are really strong. And maybe most importantly, there's just a ton of demand for the asset class from all regions of the world, all channels, and that's meeting a relatively limited amount of new supply of high yield bonds. So the supply demand dynamics are very favorable for high yield.
Why do you say, Bill, that next year our attention, our focus might shift to rate hikes?
Well, I mean, financial conditions are extremely loose right now. Stock prices are high, credit spreads are narrow. That is a risk for the high yield market, but it's offset, I think, by a lot of other positive factors. So financial conditions are very easy, and inflation is stubbornly sticking around the high 2% area. The economy is strong. We could see an unleashing of animal spirits. And so it's not clear to me that the path to 2% inflation is going to play out as the Fed anticipated when they started this rate cutting cycle off with that 50 basis point cut.
How much is fiscal policy play into all of this as well, Bill? I mean, we talk about that a lot when it comes to equity market investors. How closely are you watching it, and especially as you get into the sector level of your high yield investing?
Yeah, I mean, it's a major factor, and we'll have to see how that plays out. It may be that the Treasury market has to discipline the fiscal authorities to address the very high deficits in an economy that is basically at full employment of resources. So that's another risk for the Treasury market. The high yield market, I think you have to be careful about the tariffs and potential immigration policy, what sectors that could negatively impact at the high yield market, things like retail, things that are very labor intensive. But I think the high yield market should be more insulated with that attractive starting yield and the low duration of the high yield asset class.
Bill, always good to see you and have you on the show. Thanks for joining us.
Thank you.
Arctic Wolf announcing an agreement to acquire BlackBerry's cybersecurity segment called Cylance. The deal worth up to $160 million. Joining us now is the Arctic Wolf CEO, Nick Schneider. Nick, great as always to see you. Let's start with this acquisition, Nick. Why did you do this acquisition now, and walk us through what it's going to mean for your business?
Yeah, first of all, thanks for having me. Great to see you again. We're super excited about this. We've been on a mission here at Arctic Wolf to end cyber risk by building out our Aurora platform and providing outcomes that customers expect in cybersecurity. I think the acquisition here of Cylance is going to give us some new capabilities, native for endpoint protection, endpoint detection and response. They have a deep history and pedigree in AI. And when you combine the pedigree of Cylance, the efficacy of their solution with the Arctic Wolf Aurora platform, and while remaining open with our open XDR platform, I think we're going to be able to provide outcomes to customers that they've been looking for a long time. Be great for our customers, great for our partners, and I know that the employee base is really excited as well.
You know, Nick, you mentioned AI there, and you've been working in this industry, I know, a long time. I am curious for your perspective, how quickly you see that technology impacting the industry broadly, Nick, just, both offense and defense.
Yeah, so Cylance specifically is a pioneer in AI and machine learning and leveraging that within the endpoint. I think AI more broadly is being used offensively by bad actors on an ongoing basis, but also picking up steam with vendors like Arctic Wolf as we continue to build artificial intelligence into our solutions and the platform wholesale, which will help us to ensure that we're defending against those attacks. So I think AI is here to stay within cybersecurity. It's been with us for a long time. I think as we move into this next year, we'll see more and more AI, both on the customer-facing side of different businesses, but also being leveraged kind of within the platforms of those that can bring multiple outcomes to their customers.
Nick, the economy's growing. The Fed, the expectation is going to cut again this week. I'm just curious, given the macro, given the backdrop, broadly, what are you seeing in terms of, spending on cybersecurity right now? What does demand kind of broadly look like? If I asked you to compare it, to 6 months ago, 12 months ago.
Yeah, demand is strong. And in particular here, as we exit the year, it seems to be strengthening. I've also seen some reports through third parties that show that cybersecurity spending is looking to be up for next year, with specific markets around threat intelligence, MDR, endpoint being the core areas of spend within cybersecurity. So we're expecting a strong year for the cybersecurity market at wholesale. And I think with this combination of Cylance and Arctic Wolf, we're going to have something pretty special to offer to our customer base.
When you look at 2024, Nick, you had these big headline-making events that attracted a lot of attention and cybersecurity risk. You think about the Olympics, you think about the election. Are there events in 2025, Nick, as you look ahead that are on your radar as, again, potential real targets for cyber attacks?
Yeah, I mean, obviously the inauguration will be one, and then effectively anything that stands out within the public sphere becomes an opportunity for bad actors to leverage that as something that they can, use in phishing campaigns, or that they can use to catch individuals off guard. Identity and individuals doing the wrong thing, unfortunately, is still a number one vector for threats. And anytime there's a new event or an event that's widely broadcast or talked about, that's a new opportunity for the bad actors and something to be paying attention to.
As you mentioned these bad actors, Nick, I'm just curious, has their strategies shifted at all, especially with the proliferation of AI?
Yeah, I mean, they're still using a lot of the similar strategies that they've used in the past. Obviously, AI gives them some new technology and gives not only bad actors that would have historically played in the space new technology to leverage for things like phishing emails or even more sophisticated attacks, but it also broadens the number and the scope of individuals that might be able to participate as a bad actor, because they now have tools that may have previously felt outside of kind of their purview. So you kind of have a combination of more bad actors or more people with access to tools to create a threat, and then you have an increasing or an easier to exploit threat landscape. And that combination just means that the threat landscape, I think, unfortunately, is going to continue to evolve and escalate. And that's where you're going to have to make sure you have a really strong security posture and a really strong partner in cybersecurity to make sure your business is protected.
And finally, Nick, I got to ask you, lots of hot talk here about whether that IPO window is going to swing wide open in 2025. Arctic Wolf's been around for some time. Any talk within the company, Nick, of maybe testing those public markets next year?
Yeah, so we're focused right now on building a really strong business. I think we have one today. Obviously, we have some news today with Cylance as we work to get that integrated. But with that said, I think Arctic Wolf at some point in our tenure will be a publicly traded company. We're just waiting for the opportune time for, a combination of the market and Arctic Wolf's kind of business and strategy to align. And when that's the case, we'll be there.
Nick, always great to have you on the show. Thanks for joining us.
Thank you.
And coming up, we're taking a look at what companies are impacted by the latest defeat of DEI policies across corporate America. Stick around, more market domination over time coming right up.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetnista, your favorite financial educator. Welcome to Capital Gains, world for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
might have heard Walmart, Yahoo Finance's Company of the Year. Its low prices and convenience enticed consumers to go there over rivals, and shares of the legacy retailer soared. They're up around 80% year to date. The company, though, did recently come under scrutiny after it pulled back on diversity, equity, and inclusion efforts, known as DEI. Here to discuss more, Yahoo Finance's Brooke DePalma. Brooke, this was a change for the company.
Yeah, it certainly was a change, and there's lots of companies that follow Walmart. We know that Walmart is America's biggest employer with 1.6 million workers in the U.S. alone, and often that means that other businesses will watch the retailer, like I said, very closely. In late November, the company confirmed to Yahoo Finance that it will no longer use the term DEI or Latinx. It also will not participate in the corporate equality rating system created by the Human Rights Campaign. And it also plans to shutter its $100 million Center for Racial Equity. Now, that was already set to sunset in 2025. The company, Walmart, now plans to turn the focus to this idea of inclusion as well as belonging. And in an interview in early December, Walmart's chief people officer did tell Yahoo Finance, quote, "Our values are absolutely not changing. The specific initiatives or terms, they change over time. What we observed and felt was really important is that everyone was part of that work. And that's why we really made the shift," Donna Morris said. But investors seem to have largely shrugged off this news. Shares are up around 12% over the last month.
So what does this mean for other companies then, Brooke? Who else could be pulling back?
Yeah, well, Walmart is not alone. It certainly did make headlines, but it's not alone in this. After the Supreme Court shut down affirmative action at colleges back in June, other companies followed suit. That includes Lowe's, it includes Tractor Supply, John Deere, as well as Harley-Davidson. And most recently, a federal appeals court blocked the Nasdaq's requirement that listed companies companies have to have at least one woman, person of color, or LGBTQ members on their board. And the debate for the importance of diversity on boards, well, that largely continues, and it largely depends, well, on who you ask. Elf's Beauty's goal is to double the rate of women and diverse members at its corporate boards by 2027. Of course, that's the makeup brand, and Chairman and CEO Taran Amin recently weighed in on why the company is standing firm on its stance to promote diversity in an interview with Yahoo Finance.
Our success. Now, as good as it is that we're the only public company with 78% women and 44% diverse representation, we don't want to be the only one. So we want to use our platform for positive societal change and encourage other companies to give non-underrepresented populations a chance on their boards. Just given what we've seen and now the data that we've put out today basically shows there's a strong correlation between board diversity and the results of a company delivers.
And according to Bank of America data, which was quoted in a research study ELF conducted with North Carolina A&T University, companies with above median board gender diversity saw a 15% higher return on equity and a 50% lower earnings risk 1 year out compared with their less diverse peers. And in a new report from Bloomberg Intelligence, companies with a greater number of women on their boards delivered a 2 to 5% higher return in developed markets and a 2 to 6% lower volatility in emerging markets. But not everyone is convinced. Take a look at this. University of North Carolina professor John Hand told Yahoo Finance, quote, "We did not find any really statistically reliable correlations between today's measure of diversity in executives, both in terms of race and gender, and subsequent one-year firm financial performance." And the debate on how this all will impact a pullback of requirements will impact the future of hiring. Well, some say that Walmart's decision will lead to a hit on external sales because it will lose potential talent. But others argue that hiring solely on merit will actually benefit the company.
So obviously, you know, there's sort of cultural implications of all of this. People have their own feelings about it, but what about investors? What should they be paying attention to?
Yeah, well, I think 2025 will certainly be this pivotal moment where investors will really vote with their dollars in terms of being for DEI or anti-DEI. And I spoke to people on both sides of the spectrum here. We have had indexes that support companies that support DEI for a while here, largely emerging in 2020. That includes Morgan Morgan Stanley's Calvert U.S. Large Cap Diversity Research Index. That launched in 2020. They even launched an ETF last year that's under the ticker CDEI. Now, in order for companies to get into this, they evaluate companies as DEI leaders, improvers, neutral, or laggers. Leaders and improvers are included in the fund. We also have ones from BlackRock, as well as Impact Shares, NAACP Minority Empowerment ETF. On the flip side, I actually spoke to Azoria Partners founder, James Fishback. He's set to launch an ETF in early 2025. The ticker on that is SPXM. That's going to be the ticker. And he's looking at companies that don't have hiring targets, and those are the companies that will be included in that ETF.
I mean, there's also a lot of academic research on this subject about whether companies perform better, not necessarily in the stock market, but also profitability if they are more diverse.
Right. And how it leads to innovation, culture, as well as overall inclusivity and just, creating products that people want to gravitate towards.
Yeah. Thanks so much, Brooke. Appreciate it. Let's talk more about this. For more on the backlash to corporate DEI efforts, joining us now, Cameron Dolet-Shahi. He is MSD Lawyers partner. Cameron, thank you so much for being here. So we've been talking a lot about the changing tide on DEI policies here. What have you been seeing in your work about how the last few years have sort of evolved or at least changed with respect to these policies?
Well, I think it's important to think about the context of how this all evolved, starting in 2020 with George Floyd. And it was very important for companies to take a stance, and a very strong stance, supporting underrepresented communities. Since then, we've obviously seen the fall and the rise again of the Trump administration and the conservative movement, far-right movement in the United States, and the anti-woke movements as well. And because of that, you see now companies catering to those populations like Walmart, like Lowe's, who are now making business decisions that they made in 2020 that are now the complete opposite.
Do you think, Cameron, we did see the Supreme Court strike down affirmative action in college admissions. I'm curious what, if any, impact you think that decision had across C-suites across the country when it comes to rolling backpedaling on DEI.
Yeah, I think a major impact. Everything flows down from the Supreme Court, even though we all know it's stacked to the right based on Trump's appointments. And so you have the Fifth Circuit Court of Appeals that issued a recent decision with the Nasdaq ruling, and Nasdaq isn't going to appeal that. And I doubt the SEC will appeal that ruling as well, because they know the Supreme Court is stacked conservatively. So it has a major impact, absolutely.
So, Cameron, what does this do down the line for clients and potential clients of yours, people who feel they have been discriminated against at work? Do you think that this will have a dampening effect on, on the courts or on potentially plaintiffs' efforts in this matter?
Well, I think discrimination is still discrimination. Whether it happens to a white person or a non-white person, there's state laws and federal laws in place to protect all people from discrimination and harassment and retaliation. But with the rise of kind of this far-right movement and anti-woke policies, I have seen an increase in fear, frankly, fear of speaking up. I practice in California and in New York, so obviously liberal states, but I can imagine in more conservative states that now the policies are don't speak up and don't speak out against your employer, because maybe there won't be recourse. And that is frightening. But the hope is that we can stand on state and federal law that have been in place for decades and decades.
Cameron, there are these very well-known folks. They have big, engaged social media followings who really have DEI in their targets. I'm thinking of Chris Rufo, Robbie Starbuck. How impactful, how influential do you think they've been in getting corporate America to roll back on these DEI initiatives?
Well, this is the new media, right? People are not following, they're not reading newspapers, they're listening to podcasts, they're following influencers. So anyone with a major following that captures an audience and, a segment goes viral, a reel goes viral, that's going to have an impact throughout that person's audience. So I think what Trump did, which was capture a lot of those people, was go on podcasts, go through new media, and come to power that way. So absolutely, these forms of new media are having an absolute impact.
Cameron, thanks so much for joining us today. Appreciate it.
Thank you, guys.
Time now for To Watch Tuesday, December 17th, sponsored by Tasty Trade. Starting off on the economy, we're going to be getting monthly U.S. retail sales data for November in the morning. Economists forecasting that number to tick up to 0.5%. This is coming after a slightly better than expected increase in October, signaling a strong start to the final quarter of the year.
Moving over to housing, the new home builder confidence index coming out in the morning. That number expected to increase to 47 for December. Confidence hit a 7-month high last month, giving us more insight into an industry facing high material costs and, of course, mortgage rate headwinds.
And finally, it's award season here at Yahoo Finance. Keep an eye out tomorrow when we will be unveiling our coveted Surprise of the Year award. Yesterday, Yahoo Finance named Walmart as our Company of the Year. We're going to have more awards announcements throughout the week, including Product of the Year and Comeback of the Year.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. Got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of that curve. Here's some of the trends we're going to be diving into. It was a mixed day for markets, with the Dow continuing its slide, while the Nasdaq, though, closed at yet another new record. That's thanks to several tech giants hitting new highs, including Amazon, Tesla, and Apple. The S&P also seeing marginal gains. Plus, we'll tell you why the Consumer Financial Protection Bureau is warning Americans not to use a credit card when placing sports bets. And then, where's the beef? Turns out it's between Applebee's and Chili's. We're going to break down the feud brewing between the restaurant chains on social media. Well, the Nasdaq notches a fresh record high, aided by a rally in big tech stocks, and Yahoo Finance's Josh Schaefer joins us now with the trading day takeaways. Joshua.
Hey, Josh, yeah, another day and another day. We're just really going to be talking about a tech rally here on Wall Street, right? So I want to take a look, Josh, at just what moved today, what hit some records. So we're looking at a record for Amazon, a record for Apple, a record for Alphabet, and also a record for Tesla. Tesla shares rising another 6% today. I mean, this rally we've been highlighting over the past month, really 2 months now since the election, up over 100%. It just feels like this is a little bit of a numbers go up kind of rally for Tesla, where it's just every day it just continues. But one thing that's interesting, Josh, when we talk about this Mag 7 trade and what's been driving the market higher, you can see it in big red there. Not very often we've been talking about a Mag 7 rally when NVIDIA isn't doing that well. So here's a look at it over the last 10 days. And I brought a chart from our friend Julie Hyman using some Bloomberg data on NVIDIA versus Bloomberg's Magnificent 7 index. So here's the Magnificent 7 index from the election in white. You can see that clearly rallying, currently sitting at a record high. NVIDIA just hasn't been a part of this rally. And to me, I think the takeaway from this, Josh, is while we talk about the Mag 7 a lot and we talk about the group, all of these stocks move individually, and it's perhaps a reminder that even though we've been talking about NVIDIA so much over the last 18 months, and NVIDIA has certainly helped this rally, it really sparked this bull market, you don't need NVIDIA to go up every day for the index to go up, for the Mag 7 index to go up, or even the S&P 500 to go up. And I think maybe that's one of the early takeaways from December is you don't need NVIDIA to be supporting this rally necessarily.
Yeah, we had a strategist on today too, Josh. We're talking about this same thing, the Mag 7. He was saying, you know, so investors now kind of look at the Mag 7, or at least some of the Mag 7 as kind of quasi-staples, he said, right? Like when you start getting nervous about the economy, the Fed, Washington, at least some of those names, you know, solid balance sheet, tons of cash.
Right. Yeah, no, it's something we've been talking about really over the last 10 days, right? When you look at what the 10-year has done, going back about 3 weeks now, 10-year's up about 25 basis points. There's been a clear shift in the market of maybe rates aren't going to come down as much in 2025. These stocks have been a place that investors hide in that scenario. It'll be interesting to see how they move after Wednesday's Fed decision. But one other thing I want to highlight from today's action, U.S. economic outputs. We're looking at the S&P Global PMIs, their composite index. So that's in white here, hitting its highest level in 33 months, Josh, almost 3 years, largely driven, so you can see services and manufacturing separated by yellow and blue, a divergent story in the U.S. economy here. Services continue to boom, but manufacturing lagging.
So manufacturing looks like it's still, you know, having its troubles. Services, though, I mean, I was looking, economists telling their clients, that just looks solid. Which some of them were saying they looked at that, and at least some economists and strategists in my inbox today, Josh, were looking at those numbers. And for some of them, they were like, that was one more data point where they didn't really understand why the Fed's going to cut this.
Yeah, well, when you take this number, right, you can sort of extrapolate it into a little bit of what the overall economy is doing, potential GDP projections. So Chris Williamson, the economist over at S&P Global, does do that. He said you take this number from December, you're looking at about 3% annualized GDP, at least for the month of December. That's pretty good.
That's pretty good.
That's a pretty solid print. And you look at the Atlanta Fed GDP model projecting about 3.3% for the fourth quarter. So I think you do have a good point there, Josh. The U.S. economy seems very solid. So it'll be interesting to hear if the Fed does cut as markets expect on Wednesday, sort of why they're cutting. How does Chair Powell answer that question? Because I do think that's going to be a big question come Wednesday. And that's where I want to end, Josh. We're going to look ahead to the Fed a little bit because that's obviously the key market mover of the week, I think most would argue. And I want to pull up the SEP from September. So this is summary of economic projections, what the median forecast was, and essentially lay out where people think it's going to change. So economists think the Fed probably sees this number maybe going up a little bit. Maybe GDP is a little bit better than they felt in September. The economy is doing better, as we were just discussing, right? Also probably going to see the core PCE inflation forecast come up, though. Remember, we've been talking about 3 months of sticky inflation data here, not really falling toward the Fed's 2% target. That probably goes up. You take the sum of those two parts, you probably get the median Fed funds forecast to also go up. The debate is whether the Fed is going to project 2 cuts or 3 cuts next year. This number represented 4 cuts. No one really thinks that's going to happen. But that's sort of where the consensus is going into Wednesday, and strategists seem to think anything that teeters away from that, whether it be the Fed doesn't see more economic growth or perhaps the Fed still sees more rate cuts next year or where that rate cut path is, that's sort of expected to be the market mover, not necessarily what the Fed does in December because that cut is so widely expected at this point.
It's expected, so, and yet you have these folks who say, why though, Josh? If the economy is resilient, if inflation suggests maybe we've kind of stalled out on our progress back to Jay Powell's 2% target, if the stock market's working, why are you cutting?
It seems at this point, part of the narrative is, well, they were very restrictive for a very long time. And if we're going to work under the assumption that monetary policy has these long and variable lags, then those lags are still working their way through the economy, right? You look at areas of the economy like hiring right now in the labor market. Hiring is not really ticking higher, it's still ticking lower, and it's at an area, the labor market in general, where you're kind of in this stasis, and I'm not sure how much the Fed would want to poke the bear too much there and keep rates higher. Maybe you take it a little bit lower. Some think maybe even take it a little bit lower in January. Then you wait and see for a couple months and see where you're at. But right now, we're not that far removed from the labor market slowing story we were talking about at the end of the summer, right? Your unemployment rate still up from 3.7% to start the year to 4.2% right now. It's a pretty big move higher, and there are certain areas of the labor market that I don't think the Fed wants to bother with too much. And on the inflation story, there's a lot to be seen there. Some people argue short-term effects have been keeping those prints high. Maybe you get better prints to start 2025 and the Fed can feel a little bit better.
All right, all eyes on Wednesday with the Fed. Josh, thank you. Appreciate it. Coming up, where is the beef? The value meal war between Applebee's and Chili's took to social media last week. We're going to speak to the Applebee's president right on the other side. Stick around. Much more asking for a trend still to come. Two companies are taking the value meal battle to social media. Applebee's and Chili's displaying its rivalry in exchange that began earlier this month. Applebee's implying in a post on X that its $9.99 value deal is better than the $10.99 promotion from its competitor Chili's. Despite not tagging or directly naming Chili's, it took notice and replied back at Applebee's with a post detailing its 3 for Me value offerings. These companies are two of the many restaurant chains in the value meal arena to entice consumers amid inflation. For more on the steep competition, we now have Applebee's president Tony Moralejo, along with, of course, Yahoo Finance's very own Brian Sozzi. Tony, great to see you here on set.
Thank you for having me.
Let's start more big picture, Tony, because I'm just curious. Over at Applebee's, walk me through how the business is doing right now. What are you seeing? What are the trends?
So the trends right now are that consumers are pushing value more and more. And at Applebee's, we believe the average American should have a great meal without breaking the bank. That's why we created the $9.99 really big meal deal, right? We think it's absolutely the best value meal in America. And the social beef that we're talking about, it's just a little friendly brand personality flexing among the different brands. So we're having a little fun with it.
All right, well, when you see the social media activity, what is this? What's the vibe in the C-suite? To hell with these guys. What are they posting? We gotta get our next post up there. Is that rivalry that intense between the both of you?
When the original post came in, I was sitting right next to my CMO, and he showed it to me. I said, "Let's go right now." So yeah, it gets a little bit intense. So the gloves come off pretty quickly.
But you have to be careful not to take it too far. You're going down the rabbit hole, offering $6 meals. Like, how do you know when to stop, not get sucked in too far?
So everything we do has our franchisees' margins in mind. So we know that we need to offer compelling value. We know that we need to offer a full bundled value meal because that's what guests are looking for. But we have a pretty good sense of how far we can go.
And I think the bottom line, Tony, for investors who are listening right now is, this $9.99 offer, right? It's creating a lot of buzz and attention, which is great. But at the end of the day, they want to know, is it driving an uptick in sales, Tony? And what can you tell us about that?
So the promotion's only about 3 weeks old, and we're in a quiet period, so I can't get into too much into the financial performance. But I'll share a story with you. So day 3 of the promotion, I was in Las Vegas visiting some restaurants, and we saw probably 3 or 4 restaurants that afternoon. Every single restaurant I walked into, I saw the television commercial. And I saw our guests of all ages, whether they were in the dining room or sitting at the bar, pointing at the commercial, ordering the value meal, and we knew we had something that was resonating with our guests.
Tony, I have to ask you the tough question here. I go to Applebee's. I grew up going to Applebee's. Also grew up going to Chili's. Have both of these chains by my house in Long Island very much, and still enjoy going to them. Why is Chili's outperforming Applebee's? Why are your sales down and Chili's is posting double-digit comps or same-store sales?
So it's a great question. I don't obsess every single day with our stock price. I don't obsess over the financial performance of what one of our competitors is doing. What I obsess about every day, Brian, is how can we get better, right? And so take this value meal, for example. How can we get better? And I've got something that we're going to break right here for your listeners.
Free food.
Endless French fries.
Endless French fries.
Endless French fries. So the best value meal in America just got even better.
When does that start?
It starts on Friday.
Endless French fries.
Endless French fries and free refills.
This promotion you've talked about, Tony, the $9.99, when does that end? Is there a date?
No, it's for a limited time. It'll run through the end of the month. It'll likely run a little bit longer after that. We'll monitor the performance. We'll discuss with our franchisees. Obviously, there might be some margin pressures that we need to be sensitive about. But so far, we've got the green light from our franchise operators.
I mean, you saw, I imagine, what Endless Deals did to Red Lobster and many other chains. How do you prevent that situation? Red Lobster's a disaster, and they're still a disaster.
Yeah, I don't think what's happened to Red Lobster and some of the other brands that are out there is going to detract from our growth.
They're giving away free fish. I mean, you can't make any money on that.
French fries aren't the same as fish, but
did you think, Tony, was the French fries in response? Okay, well, if Chili's is going to give us unlimited salsa and chips, we got to come with the fries?
Actually, not. I mean, salsa and chips. It's filler, right? It's like some brands give you bread. Like when I was a little boy, my mom used to say, "Don't fill up on the bread," right? Because you want to save your appetite for that center of the plate sandwich. And our sandwiches are massive.
They are massive. They hang off the plate. And it's not just you; it's also your competitor. You guys are making some big burgers.
Size matters.
Yeah.
Right.
Yeah. Yes, it does. Before we let you go, you study your consumers. Your consumers are very economically sensitive. How challenging is that consumer segment right now? When I see a lot of shoppers, I think they're going into Walmart buying frozen food, and maybe they're not going out and eating as much as like they used to.
they're under a lot of pressure, and the competition for share of wallet is intense. But that's where you have to rely on your differentiator. And for us, is you're going to get fast food prices with full service attention, right? You get that full service experience. You're not getting a burger and a sandwich put on a plastic tray with a couple of ketchup packets and maybe a napkin if you're lucky, right? You're getting service from a friendly greeter, from a friendly service. You're going to get it in a warm and welcoming environment. And so that to me is the biggest differentiator. And that to me is real value.
Well, what if you have to respond? If Chili's comes out with a new promotion, I mean, your endless fries, do you expect a response from them?
I don't know. You'll have to ask them that question.
Okay. Well, Tony, I don't know. Now I'm just hungry for fries. My takeaway from this segment.
Fries
Tony,
are excellent.
Thank you so much for joining us. Appreciate your time.
Pleasure being here. Thanks, guys.
And coming up, bettors beware. A new way to wager on sports has the Consumer Financial Protection Bureau warning users. More on that when Asking for a Trend returns. The NFL playoffs are right around the corner, and Washington's top consumer watchdog has a word of advice for fans. Don't place your bets using a credit card. Joining us now is Yahoo Finance's Jordan Weissman. So Jordan, the CFPB saying, word of advice, don't place your sports bets with your credit card. How come, Jordan? What are the risks we need to know about?
Well, they don't want your winnings to be eaten up by credit card fees. The secret that a lot of people don't realize when they fund their, FanDuel or Caesar Sportsbook account with a credit card is that money gets charged as a cash advance by their credit card company. And that typically comes with a 3 to 5% fee. It's not just a normal credit card charge. Cash advance costs extra. Or it could be a flat $10. And that's a big problem for a lot of gamblers come playoff time, because this is when in the year you start to see a lot of infrequent gamblers start placing wagers, a lot of people making small bets just for fun during the playoffs. It's a good way to eat up all of your winnings, essentially, if you place your bet with a credit card.
And do we know, Jordan, how many fans actually rely on credit?
We don't know the exact number, but the CFPB came up with a really kind of smart way of figuring out if this happens and how often it seems to happen. And what they did was they looked at the data for what occurred when Kansas legalized sports betting online, right? And what they found is that when that happened, there was a huge surge in cash advance fees, right? And there was no real other explanation for this except for maybe people were funding their sports bets with their credit card. And then lo and behold, the same exact thing happened in Ohio. So it seems, and then afterwards, it leveled off a bit. So it seems to have happened is people tried gambling with their credit cards, realized it was costing them a fortune, or at least costing them their winnings, and then for the most part learned not to do it. However, in surveys, about 25% of gamblers still say they prefer to fund their betting on credit, which just doesn't seem like the most financially sound thing to do, both in terms of cutting into your take, but also possibly letting you gamble with money you don't actually have.
So did the CFPB, Jordan, do they say what the better method in their opinion would be? Would it be debit cards?
Yeah, use a debit card. use the money you have.
Have states stepped in, Jordan, in any way? Have we seen local state agencies step in and say, listen, we're not going to allow folks to bet using credit cards?
Yeah, there are a handful of states that have just banned that practice outright. Massachusetts, Rhode Island, Iowa banned it. And that probably has less to do with the amount of money that credit card companies are charging in fees and more to do with just the flat out risk to consumers that people are going to get in over their heads, right? In general, it's probably not, I'm repeating myself a tiny bit, but it's best not to gamble money you don't have.
Seems like sound advice, Jordan. Thank you for joining us. Appreciate it.
Thanks for having me on.
And now for our chart of the day, we're looking at forward PE of the Mag 7 versus the other 493 names in the S&P 500. And Yahoo Finance's Julie Hyman joins me now with a closer look. Julie.
Yeah, this has to do with valuation here. We've been talking a lot about broadening and lack thereof, that the Magnificent Seven are still dominating here. And Scott Chronert over at Citi brought us this as part of his outlook for 2025. And he observed that what we have seen here from the price to earnings over the next 12 months, so forward PE, in other words, for the Magnificent Seven, it's actually below where it was back in 2020. It's been trending up a little bit, but it's below its most elevated levels. Then we've got the S&P 500 and the S&P 500 minus the Mag 7 that have also been trending higher and are in fact approaching their prior high. So he says on a relative basis, they've actually been pricing in a lot of optimism. So here's what Scott had to say about that.
What this tells you is, to my earlier point, the market is quickly pricing in a lot of soft landing enthusiasm, AI tailwinds, and then, as I mentioned, the opportunity around the Trump policy platform. So it's this other 493 that we need to see stabilize from a fundamental perspective and then broaden, and we think that's going to be the case for next year.
So in other words, kind of will grow into this pricing, so to speak, as we do see earnings growth for the other 493 expand. And, that's in fact been subjects of some other charts of the day for us, Josh, where we have seen that while earnings growth for the Magnificent Seven is still going to outpace the rest, the differential is going to shrink. We're going to see the 493 start to catch up in terms of growth, and we're going to see a bit of a deceleration in growth from the Mag 7.
I also thought it was, Julie, I thought it was interesting how Mr. Chronert talked about Mag 7, how he framed how he thinks investors look at those names, or at least some of those names, as sort of quasi-staples now.
Yes.
They get a little worried, about the economy, the Fed, about Washington. They start looking at those names as defensive moves.
Yes, although, as we also talked about, you can't discount the idea that people are sort of performance chasing into year end as well. So it could be a number of different factors driving up those Mag 7s.
Earnings, defense, chasing performance, it's all there. Julie, thank you. Appreciate it. And that is a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.